What's up, everyone? Welcome back to the program. Yesterday, we had Jerome Powell speaking from Jackson Hole at the Fed Symposium, where every year in late August, the Fed reveals their monetary framework to the world. And in this one, Jerome Powell taking a rather dovish stance. The market wasn't sure exactly what was going to happen, but here it is, the headline here from the FT. Jay Powell paves the way for the Federal Reserve interest rate cut in September. U.S. stocks and bond rally as central bank chair says economic risks are shifting. So, essentially, he talked about how, the Federal Reserve was focusing a lot on the inflation side of their mandate, and that now they're seeing things turn, and that the employment, the job market is becoming more important. And of course, we've seen over the last few months, the job market weakening and the inflation on a steady track. And of course, Jerome Powell was heavily criticized by a lot of people, including President Donald Trump, for being too late. And it has been, of course, the base case scenario on this channel, if you've been following, that the Fed was going to be late ever since they unleashed inflation under Biden by running the economy too hot, the monetary policy too hot. It was sure that they were going to be late, that they were needing to trigger a recession to be able to bring the inflation cat back in the bag. And so this is basically what we've been expecting. And now Powell is sort of backtracking, and perhaps the latest job revisions, what we've seen, massive job revisions with some people at the BLS getting fired for overstating the job numbers by incredible margins, like over 90% error on these numbers. And now we're seeing perhaps the Fed and Jerome Powell panicking a little bit. But, as we said, this is what we expect and what we've been expecting for a while. So, to sum up what he said, essentially, in the usual Fed speak, the Fed is, on top of their both mandate, inflation and employment. They're not going to let inflation come back, and they're going to take action if ever they see that the Trump tariffs are raising inflation. But that they expect that the tariffs will be a one-off and, a one-time increase in prices, not something that is going to be sustained over time, the way inflation is month after month. And that they're focusing really now on the employment side of their mandate, with the weakening that we've seen in the recent job number revisions. And another thing that they talked about was the average interest rate target. If you remember, under Biden, they switched to this average interest rate target of 2% instead of a 2% target. And that allowed them to run the monetary policy a little bit hotter than it would be otherwise by, essentially, if you have a spike above 2%, well, you just take the average, and the average will be under the spike, so you can continue to run the monetary policy hot. And now we've been over 2% for a long time. Then, essentially, if they were keeping this average target, then they would have to run the inflation target under 2% to bring it at a 2% average. So they're getting rid of that, meaning as soon as we are, within the ballpark of 2%, they can cut rates, and perhaps they will do so in September. Essentially, when they wanted to run the economy hot while inflation was at target, then they found a way to do it. And now we're above 2%, and they're still going to find a way to run the economy hot. So no matter what, with the Fed, they always want to juice up the economy and the market. But it doesn't really matter because, as we said, on this channel. They're going to be late. They are late. They know they are late. They know they have created substantial damage in the US economy. And now there is, nothing that is going to stop this train. It doesn't matter if they're cutting rates now in September. They should have been cutting a long time ago, and they know it. And they know there is going to be disastrous consequences for the US economy. And that's why now, he is pretending to be very worried because he knows what's coming. And of course, his term is going to, end in 2026. So it's going to be the final months for Jerome Powell. And we know that monetary policy, it has a lag, 9 months, 12 months. So by the time he leaves his post mid 2026, then the problem he has created will be for somebody else to handle. And the crisis that will follow, well, it will be somebody else's job to fix his mistakes. But we're going to have a quick look here at the charts to talk a little bit about this and to see perhaps where this market is going to go. So here is the S&P. If you remember back in April here, in one of our last videos on the market here, we had told you guys that, it was everybody was way too bearish on this tariff narrative, and we were breaking out here on this downtrend, and that the market was going to go back up. And we said back then, look for a marginally higher high, and then you're going to have a sort of a make or break moment for the market. And that's exactly the scenario that we've seen here, as you can see. From this breakout point here, we've run now almost 20%, 18% here, and we've actually managed to break that previous trend line here from the top, from the previous top, and we actually went and retested it and confirmed, and we've been moving up from that now. But as you can see here, we have momentum slowing down, and there's only one day here that we have since the Powell speech. So we're going to have to see in the coming days and weeks what is going to be the effect of this shift of monetary policy here from the Fed. But you can see clearly momentum slowing down. Let's pull the RSI here. As you can see here, let me make it a little bit bigger. So you can see here a divergence, a clear divergence between the price here, where we are making higher high here in the price, and the momentum here going down, a bearish divergence. And this is what you see, this is what we saw in this period here, where we're making higher highs in the prices, and we were making lower highs in the momentum. And you can see, what was the result here. We went down pretty strong, and now we are in a similar situation. So are we going to see a similar scenario? Well, we'll have to see, can this trend be reversed now that there is a shift from the Fed? Perhaps that could be the case. But it also is possible that the damage has been done, and that anyway momentum was already slowing down before the announcement. And as we've been saying, perhaps in this market now there's going to be new people coming in that are going to be thinking that the Fed has the back of this market and is going to push the market up. It is not impossible, but if we are right in our assumption that damage has been done to the economy by the Fed policy over the last year, and that this is going to translate in the future 9 to 12 months into bad consequences for the US economy, then perhaps we're going to see one last push in this market before things actually turn ugly. and we have seasonality coming in September. It always is a bad month for the market. So something to watch, perhaps. There is going to be we're going to retreat a little bit in September. Some uncertainty whether they're going to cut or not. We're going to have economic data. If there is some bad economic data, then perhaps the market is going to be unsure. Will they cut or not in September? Then in September, they're most likely going to cut. If they don't cut, then that is probably it for this market. But if they do cut, which I expect they do, then perhaps it will reignite this market and we can have a push up until the end of the year. And then things are probably going to start to settle in and people are going to realize, there is damage to the economy, and the stock market being at all-time high when things in the real world are not going that well doesn't make sense, and perhaps then we will see this market turn around. Let's have a quick look here at the DXY. So DXY, we've been talking, of course, a lot about the dollar going down since the beginning of the year here. As you can see, the DXY was at 110. We are at 97 now. But as you can see here, we're creating a base. And, we're going to have to see. And that doesn't really make sense if you think about it, because interest rates have been high during this whole period where the DXY was coming down. And now that the Fed is saying that they're going to drop interest rates, now we're creating a base. We should be dropping down massively if the interest rates would be going down, but that is not the case. And, we've been a little bit in this bizarro world since the beginning of the year, where we have the dollar going down with the sort of the markets going down, and when it is the opposite, when the dollar is going strong, then the market is going strong. And that is because actually it is not a matter of the value of the dollar versus the value of the S&P. It is a matter of capital flow going in and out of the US system. And so it is sort of both of them moving in the same direction. Either capital is going to the US and then the dollar is strong and the S&P is strong, or capital is moving outside the US and then the dollar weakens and the S&P goes down. And that is, of course, because of the political choices that in the policies that have been enacted by Donald Trump here in the beginning of his presidency. So here, watch out, because we could see actually the dollar going up against all expectations despite rate cuts. And if that is the case, perhaps it is foreshadowing a slowdown in the US economy and the global economy, and perhaps a global recession, that we'd see the dollar, of course, spiking up as being a safe haven from the global turmoil. Let's have a quick look here at the yields. 2-year, now we've been steadily going down here, and I expect it's going to continue in the same way. The rest of the curve is sort of following the same kind of path here, but of course not as fast as the short end. Let's have a quick look here. And the 30-year, as you can see here, we've been stalling around the 5% mark. And perhaps this is where it's going to stay for a while, but eventually it is going to follow the rest of the curve. And, it is perhaps foreshadowing what's happening here in the economy. Let's have a quick look at gold here. Gold, we're going to see here, we have a consolidation here. Do we break up or do we break down? I'm thinking that everybody is expecting gold to break to the upside. And so what would the market want to do if that was the case? No, to bring it down and to essentially hurt all those people who have now getting into gold, onto the gold train way too late, and bring the price down here to this trend line. So perhaps around the 3,000 mark. Gold could be a good buy here for a continued run to the upside. But, from this consolidation, I would be skeptical for gold to continue higher without a pullback, because it has been going so strong for so long with no respite, and it hasn't pulled back at all. And perhaps now it is a good moment, now that you have all these people who have gotten late into the trade, to bring the price down and put these people underwater and try to shake them from their gold. Let's have a quick look here at Bitcoin. And Bitcoin, of course, reacting, as it is usually the case, on a T to the policy and to the global liquidity. And as you can see here, this fractal, this yellow fractal that has been guiding me here ever since the breakout of November last year, and it has played to a T, and it doesn't look good at all here for the Bitcoin price going into the next few months. And of course, that doesn't mean that this is going to repeat. This fractal is just a copied from the previous topping pattern on Bitcoin from the previous cycle. But as you can see, the previous cycle was almost following the exact same pattern on the last months of the bull market. And if that's the case, then we're probably at the top here, and we'll see. Everybody's expecting now Bitcoin to rage up and to go, to 150K or 200K right here from this point, essentially just putting something like this. But is this really a plausible scenario? I mean, it's not impossible. I guess, we've seen some crazy moves on Bitcoin, but perhaps now that everybody is looking at this as the trade in the coming months, and it seems we having, a lot of difficulty here for Bitcoin to move up. As we can see here, the moves have been smaller and smaller. As we are climbing up in price here, every single time we are sort of taking an impulse on the previous highs here. So here, we went up, and when we went down, we went to the previous high here to find support. Same thing here, we've just did around the 110 mark. And now the momentum has been sort of like the S&P. The momentum has been muted. Now we really lost, the strength of the move. And despite the very dovish conference by Jay Powell, Bitcoin is still at 115 right now, and it went all the way up to 125 just a few days before this press conference from Jerome Powell. So we haven't had really Bitcoin even regain the level that it was before the conference, when people expected a rate cut with something like 80% certainty, and now we're above that. We're almost under 100% guarantee for September, and yet we are not climbing up in price back to that level. And we have, of course, here our big resistance level. So is this sort of confirmation? Are we here testing back this green box here, testing back this price level, rejecting, and then going to go down from here? We will see. But we know seasonality, as in the stock market for Bitcoin, it is not good in September. Perhaps we will sort of flush down and clean a little bit the excess leverage into Bitcoin to find another impulse and to get higher in the last months, October, November, December, which are usually very good months for Bitcoin, usually when the cycle ends. But if we follow this fractal here, perhaps that is not the case, and perhaps we've topped here at 125 for this cycle. It's, of course, all going to depend on what happens in the economy, and whether the damage from the Fed and the tight monetary policy will remain, and whether they will affect us at the beginning at the end of this year, I would say, rather than being contained for next year. We will see what happens in that regard, but Bitcoin for sure is going to be a sort of a canary in the coal mine for the broader market. If we see in the coming weeks and months Bitcoin actually flush down, when everybody accept the seasonality of Bitcoin to be very bullish and to bring new highs in the months of October and November, especially. If we don't see Bitcoin making a new high, then perhaps it is a harbinger for the broader market that we have some real trouble coming in the next few months, and perhaps in 2026. So that is it, guys, for today. Thank you for watching this video. Don't forget to subscribe to the channel and leave a like. I will see you all on the next one. Peace.
Hit me with that like, and sub to the channel. Hit me with that like, and click the effing bell. Click that bit, alright. The algo recommends, for she gon' like. The algo knows you well. Hit me with that like, subscribe to the channel. Hit me with that like, and click the effing bell.